This is part 1 of the lecture for chapter 10. In this part of the lecture, we're going to look at current liabilities. And current liabilities are obligations that must be satisfied within 1 year or less. So, in this first slide, we have a definition of the current liability, as I had briefly explained. And if you look in the yellow box, you see examples of current liabilities. And the word payable is always a hint that we have a liability. There's one current liability shown here that does not have the word payable attached to it, and that is unearned revenues, and we will talk about that a few slides from now. Right, a note payable. First of all, a note is a promissory note. So it's an actual document that the borrower signs. And it includes information such as the date that the loan was made, the due date of the loan, the face amount of the loan, and the interest rate at which interest will be paid. The notes can be used for both short-term and long-term financing needs. And of course, the note requires the borrower to pay interest. Alright, so we have an example here of a note payable problem. First National Bank agrees to lend $100,000 on September 1st, 2017 if Cole Williams Company signs a $100,000 12% 4-month note maturing on January 1st. Alright, so the note is made on September 1st. It matures or is due January 1st. So there are 3 entries that they're asking for. First one, prepare the entry on September 1st. Second one, prepare the adjusting entry on December 31st, assuming monthly adjustments have not been made, and prepare the entry required on January 1st, 2018, which is the maturity date. And the next slide will have those entries. So September 1st, the loan is made, so that Cole Williams will debit cash for $100,000 and credit notes payable for $100,000. So what that is saying is that First National Bank is giving $100,000 in cash to Cole, so the cash account has to go up. However, this is not a gift. Cole Williams will have to repay the bank, so we need to credit notes payable for $100,000. The second entry was to prepare the adjustment for interest from September 1st to December 31st. So if you count, it's all of September, all of October, all of November, and all of December. So down below, under the entry, you can see how the interest is calculated. We take the principal balance or the face amount, multiplied by the percentage rate, which is always expressed as an annual rate, and then by 4 months over 12 months. And that 12 months, of course, represents 1 year. But what we're doing is we're recognizing interest for 4/12 of a year or 1/3. So we need to debit interest expense of $4,000. That says that for the 4 months of 2017, Cole Williams had use of First National Bank's money. We need to credit interest payable of $4,000. So what that is saying is that Cole Williams will have to pay that $4,000 to the bank. Alright, so now we have the entry that's made on the maturity date, where Cole is repaying the bank the face amount or the principal balance of the note plus the interest. So on September 1st, we had credited notes payable for $100,000. Now they're going to pay off that debt. So we debit notes payable for $100,000. On December 31st, we had credited interest payable for $4,000. Cole is also paying that, so we're going to debit interest payable for $4,000 and then credit cash for the full $104,000. All right, sales tax. First of all, you've probably seen signs in some stores where it says, "We do not charge sales tax. We collect sales tax." And of course, it is expressed as a percentage of the sales price. So the retailer collects the tax from the customers. They have to then remit those collections to the taxing agent, whether it be a state or whether a county. So we have an example here. The March 25th cash register reading for Cooley Grocery shows sales of $10,000 and sales tax of $600, which is 6% of sales. So they're getting $10,600 from the customers. So we debit cash for $10,600. We credit sales revenue for $10,000 and credit sales tax payable for $600. That sales tax payable account for $600 signifies the fact that Cooley is going to have to remit that $600 to the state. So they owe that money to the state. So when they actually disperse it to the state, they would debit sales tax payable and credit cash for $600. Another area, and this is a major accounting function of a corporation, is payroll tax, or payroll and payroll taxes. We're only looking at a few slides. We're only going to get the basics here. But there could be a week or so spent on this topic. All right, so the term payroll pertains to salaries, and salaries would mean that these people are not paid overtime. And wages, these people are paid, the people are making wages, store clerks, factory employees, manual laborers, they're getting paid on an hourly rate. Right, so we're going to look at three different items with respect to payroll: the gross earnings, the payroll deductions, and the net pay. And the next slide will give us an exhibit or a diagram of this. Alright, so we have the gross pay, and of course we all know that there are quite a few things that are taken out of the gross pay before we get what is left. So if you look at the bottom left-hand side of this diagram, we have insurance, pensions, and or union dues. So insurance, of course, medical insurance, which we know continues to become very expensive. Dental insurance, life insurance, disability insurance, pensions. For most of us, there are no pensions like there had been years ago. We have 401k plans. Now, government employees still have pensions, and they have the defined benefit pension, in which the amount that they're going to receive during retirement is fixed or determined. So they are assured of what they're going to get. Then we go to FICA taxes. That includes Social Security and also Medicare. Next, the federal government income taxes, followed by state, city, and local income taxes. And then another example of a withholding could be for charity. So if through payroll deductions you make a donation to the United Way. That would come out. All right. So then, after everyone gets what's owed to them, then you have your net pay. The next slide is going to show a journal entry for payroll so you can see what this looks like. All right, so Assume Cargo Corporation records its payroll for the week of March 7th as follows. There's a debit to salaries and wages expense for $100,000. That is gross pay. A credit to FICA taxes payable of $7,650. A credit to federal income taxes payable of $21,864. A credit to state income taxes payable of $2,922. And a credit to salaries and wages payable of $67,564. So if we go back and look at the payables, the FICA taxes payable, the corporation or the employer must remit that to the government. Also the same with the federal income taxes and the state income taxes. The salaries and wages payable represents the net pay. That's what the employees get after the government, for all intents and purposes, has gotten what's owed to them. So you start off with $100,000, and what goes to the employees is $67,564. So now when the payment of payroll is made, we debit salaries and wages payable and credit cash for $67,564. Now, the employer also pays taxes, payroll taxes, so that the employer has to pay FICA as well. So the amount of FICA that the employer pays for the employee is equal to what the employee pays. The employers also have to pay federal unemployment taxes and state unemployment taxes. So here's an example of an entry for employer payroll taxes. So based on Cargo Corporation's $100,000 payroll, the company would record the employer's expense and liability for these payroll taxes as follows. So there'd be a debit to payroll tax expense of $13,850. A credit to FICA taxes payable for $7,650. A credit to state unemployment taxes payable of $800. And a credit to federal unemployment taxes payable of $5,400. So what this company is doing is they're recognizing the expense when they incur that expense, and the fact that they've credited 3 payable accounts means that they have yet to distribute the funds to the government. Right, this is important here. Employer payroll taxes do not include, and as you can see, the answer is federal income taxes. We just discussed that the employer payroll taxes are federal unemployment, state unemployment, and FICA. These slides on called Do It, I'll go through a couple of these. We have an example. During the month of September, Lake Corporation's employees earn wages of $60,000, so that is the gross pay. Withholdings related to these wages were $4,590 for Social Security or FICA, $6,500 for federal income taxes, $2,000 for state income taxes. Costs incurred for unemployment taxes were $90 for federal and $150 for state. So there are 2 entries that need to be made. We have to make the entry to record the payroll, and then another one to record the company's payroll tax expense. All right, so in this slide, we have the entry to record the payroll. We're debiting salaries and wages expense, $60,000 for the gross pay. Credit FICA taxes payable for $4,590. Credit federal income taxes payable for $6,500, credit state income tax payable of $2,000, and credit salaries and wages payable of $46,910. So that $46,910 is the net pay that will go to the employees. Here's the entry for the company's payroll tax expense. We debit payroll tax expense for the total amount of $4,830. We credit FICA taxes payable of $4,590. Remember, what we had said is that what the company pays is equal to what the employee pays, and if you go back to the prior slide, you can look at that and you can see that the amounts are equal. Credit federal unemployment taxes payable of $90 and state unemployment taxes payable of $150. I had mentioned unearned revenue when we were looking at the slide that provided the definition of liabilities. For unearned revenue, what happens here is that the company receives cash from customers before they do anything for the customers, before they provide a service or deliver goods. So when they receive that money up front, they incur liability of unearned revenue. They owe a service, they owe a product. So in the box, they give some examples of businesses that would record unearned revenue, and we'll just look at the first one, the airlines. You buy your ticket up front. So what would happen here is that the airline would be getting cash, so we would debit cash for whatever the amount is for the airline ticket, let's say $250. We credit unearned ticket revenue for $250 because we pay for the ticket, we haven't used it yet. However, when we use it, we're going to debit unearned ticket revenue for $250 and then credit ticket revenue for $250. So what we'd be doing there is we would be zeroing out the liability because now the customer has used the ticket and the airline can recognize that revenue. And we have an example here. Superior University sells 10,000 season football tickets at $50 each for its 5-game home schedule. The entry for the sale of the tickets on August 6th, debit cash, credit unearned ticket revenue for $500,000. As each game is completed, Superior records a recognition of revenue with the following entry. Debit unearned ticket revenue, credit ticket revenue for $100,000. So if we go back, total amount they get up front is $500,000. There are 5 games, so for each game they would recognize $100,000. So $100,000 is removed from the liability of unearned ticket revenue and is transferred into the ticket revenue account, and then of course each time that's done there'd be an additional $100,000 recognized as revenue. Alright, now we come to one other current liability account. It's current maturities of long-term debt. So if we think of examples of long-term debt, obviously we have student loans and that those are payable over many years, car loans, and also mortgages. So each year a portion of that outstanding debt must be paid, and that the amount that must be paid within the year would be reclassified under current liabilities. And as this slide indicates, there is no adjusting entry required for this. So if we look at our example, Wendy Construction issues a 5-year interest-bearing $25,000 note on January 1st, 2017. This note specifies that each January 1st, starting January 1st, 2018, Wendy should pay $5,000 of the note. When the company prepares financial statements on December 31st, 2017, what amount would be reported as a current liability? And it would be $5,000 because that $5,000 has to be paid within the year. And then the remaining $20,000 would be included as a long-term liability. The last three do-it slides I am not going to go through. You can look at these on your own, and then if there are any questions on them, you can look up the information in the book, or of course you can contact me and I'll certainly be happy to help you out with it. So this concludes part 1 of chapter 10. So we've covered everything that we're going to do with respect to current liabilities. And the next thing we're going to look at is long-term liabilities, but what the focus will be on bonds. We are going to go through the basics of bonds. If you look at the chapter, you're going to see there's much more detail than what we're going to look at. And you would be looking at bonds in more detail if you're accounting majors. You'd look at it in probably accounting 211 and definitely in intermediate 2.